Jai Hind everyone. Welcome to my YouTube channel, which is Explore Yourselves, Banking and General Knowledge, etc. Today I will discuss interview questions and answers related to the internal promotion examination for banks. Welcome to part 5 of my Path to the Corner Office 2025 to 2026 series, where I simplify bank promotion examination interviews, practical sample questions and answers, examples to help you climb the banking career ladder faster. Interview questions and answers, especially from Credit Policy and Lending Framework 2025. What is the objective of the Credit Policy and Lending Framework? The answer is the objective is to maintain a healthy balance between credit growth, earnings, and asset quality while ensuring compliance with RBI guidelines, corporate goals, and social responsibility. It provides a structured framework for sanctioning, managing, and monitoring credit risk. Why is the credit policy called an umbrella policy? The answer is because it provides overarching principles for credit risk management, while product specific, sector specific, and operational guidelines are maintained in separate documents like Industry Outlook and Lending Framework, Manual of Instructions, etc. Explain the credit philosophy of the bank. The answer is the bank follows prudent lending based on the 6 C's of credit: character, capacity, capital, collateral, conditions, and credit score, ensuring ethical, transparent, and compliant credit decisions. What is meant by credit culture? The answer is credit culture refers to professional, fair, responsive, transparent, and compliance oriented behavior of credit officers while appraising, sanctioning, and monitoring credit. Who are the major clientele segments of the bank? The answer is retail, MSME, agriculture, corporate, government entities, PSUs, and overseas clients. Why does the bank emphasize retail lending? Retail lending helps diversify risk, improves asset quality, enhances spreads, and provides cross selling opportunities. What are the modes of banking arrangement? The answer is sole banking, multiple banking arrangement, consortium banking. What is the importance of MSME lending? The answer is MSMEs are growth engines of the economy, generate employment, and offer risk diversified lending opportunities with priority sector benefits. What precautions are required under multiple banking arrangements? The answer is borrower must disclose facilities from other banks, allow exchange of credit information, and total WC limits should generally remain within 10% of assessed limits. What is due diligence in credit? The answer is it is a comprehensive assessment of borrower's background, management integrity, financials, market position, legal status, and compliance. When is enhanced due diligence required? The answer is for borrowers with exposure above Rs 50 crores, including deeper scrutiny of management, group exposure, cash flows, and risk factors. What is LEI and why is it important? Legal Entity Identifier (LEI) uniquely identifies borrowers and improves transparency in large value transactions and aiding systemic risk monitoring. What is the role of independent appraisal? The answer is to ensure unbiased assessment of credit proposals, especially for large or sensitive exposures. Why is market information important in appraisal? The answer is it provides insights into borrower reputation, payment behavior, industry standing, and internal risk factors. What is debt, EB or EBD, EBITDA, and why is it introduced? The answer is it measures leverage and repayment capacity. Introduction improves assessment of cash flow, sustainability, and financial discipline. Name key financial ratios used for appraisal. The answer is DSCR, current ratio, TOL or TNW, debt equity ratio, interest coverage ratio. What are financial covenants? The answer is conditions imposed to maintain minimum financial parameters and safeguard the bank's exposure during the loan tenure. What is sensitivity analysis? The answer is it assesses impacts of adverse changes in revenue, costs, interest rates, and or cash flows on repayment capacity. What is meant by quality of capital? The answer is it evaluates whether promoter contribution is genuine, unencumbered, and sustainable. What is independent credit risk evaluation? The answer is CREC provides an independent risk assessment of proposals to ensure objectivity and prudent credit decisions. What is the role of Chief Risk Officer? CRO. The CRO oversees credit risk framework, risk limits, portfolio quality, and compliance with risk appetite. What is large exposure frame? The answer is RBI mandated framework limiting exposure to a single counterparty or group to control concentration risk. What is RAROC? The answer is risk adjusted return on capital measures profitability after considering credit risk, ensuring capital efficiency. Which exposures are exempted from RAROC? The answer is certain priority sector loans, government backed exposures, and policy driven lending as prescribed. What is meant by secured and unsecured advances? The answer is secured advances are backed by tangible or financial collateral. Unsecured advances rely on borrower strength and guarantees. Why is valuation of collateral important? The answer is to ensure adequacy, realizability, and protection against erosion of security value. What precautions are required while accepting collateral? The answer is clear title, enforceability, valuation, insurance, and proper documentation. What is dilution of security? The answer is reduction in collateral coverage permitted only with competent authority approval. When can substitution of collateral be allowed? The answer is when alternate security is of equal or better value and risk profile. What is digital lending? End-to-end technology-driven credit delivery using automated rules, scorecards, and digital onboarding. What is business rule engine? Automated decision-making engine for eligibility, risk assessment, and limit computation. What is green financing? The answer is financing projects that promote environmental sustainability, renewable energy, and climate resilience. What are ESG risks? The answer is environmental, social, and governance risks are that may offer that may affect borrower sustainability and credit quality. Why is climate risk important for banks? The answer is climate events can disrupt cash flows, asset values, and long-term viability of borrowers. What is review of relationship? The answer is annual assessment of account performance, compliance, rating, and future strategy. What are early warning signals? The answer is indicators such as irregular operations, financial deterioration, or market issues that signal stress. What is exit policy? The answer is framework for orderly reduction or exit from high risk or non-viable accounts. What is restructuring? Modification of loan terms to revive viable stressed accounts as per RBI guidelines. What is the role of credit monitoring? The answer is ensures end use verification, covenant compliance, timely review, and asset quality protection. Why is governance critical in credit? The answer is it ensures accountability, transparency, regulatory compliance, and prevents credit failures. What is the role of board in credit policy? The answer is approval, oversight, risk appetite definition, and strategic direction. What happens if policy conflicts with RBI guidelines? The answer is RBI guidelines always prevail. Why were industry specific policies removed from the credit policy? The answer is to simplify the umbrella policy and avoid frequent amendments. Industry specific norms are now covered under a separate document called Industry Outlook and Lending Framework. What is the sunset clause in credit policy? The answer is it mandates periodic review and revision of the policy to keep it aligned with regulatory and business changes. What is meant by strict compliance in credit policy? The answer is branches must adhere to policy without deviation unless specifically permitted by competent authority or RBI guidelines. What is credit origination? The answer is the process of identifying, sourcing, evaluating, and onboarding new credit relationships. What precautions are required while takeover of accounts? The answer is assessment of conduct with existing bank, justification for takeover, pricing discipline, and compliance with takeover guidelines. What is IBPC? Interbank Participation Certificate used for liquidity management and asset acquisition without transferring borrower relationship. What is pool buyout? The answer is acquisition of a pool of loan assets from another bank or NBFC after due diligence. What is co-lending? Joint lending agreement where loans are shared between banks or NBFCs to expand credit reach and manage risk. Why is independent credit risk evaluation necessary? The answer is to ensure objectivity, avoid conflict of interest, and strengthen risk-based decision making. Which proposals must be routed through CREC? The answer is large value, high risk, policy sensitive, and deviation proposals as prescribed. What is the role of risk management groups, RMGs? The answer is portfolio monitoring, sectoral exposure analysis, stress testing, and risk mitigation. What is meant by risk appetite? The answer is the level and type of risk the bank is willing to accept while pursuing business objectives. How does the policy help in controlling concentration risk? The answer is through exposure norms, industry gaps, group limits, and large exposure framework. Why is group exposure analysis important? The answer is it prevents indirect overexposure and assesses consolidated repayment capacity. What is independent market information? The answer is information obtained from external sources like market reports, other banks, and industry feedback. Why are shareholder guarantees taken? The answer is to align promoter commitment and provide additional comfort to the bank. When are third party agencies used? The answer is for valuation, technical appraisal, legal verification, and forensic analysis. Why is end use monitoring critical? The answer is to prevent diversion of funds and early detection of stress. What is DSCR and its importance? The answer is debt service coverage ratio measures borrowers' ability to service debt from cash flows. Why are financial covenants tested periodically? The answer is to ensure ongoing financial discipline and detect early deterioration. What happens if covenants are breached? The answer is account is flagged, corrective action initiated, and sanction terms may be reviewed. What is unsecured or subordinated loan by promoters? The answer is funds infused without security, strengthening borrowers' capital base. Why is quality of capital emphasized? The answer is to ensure promoter contribution is genuine and not debt funded. What are go or no go parameters in digital lending? The answer is predefined eligibility criteria that automatically accepts or rejects proposals. What are digital scorecards? The answer is algorithm based risk management, risk assessment tools using borrower data. Why are some traditional norms waived in digital lending? The answer is to improve speed and customer experience while managing risk through technology. What is aberration from traditional lending? Deviation from conventional appraisal methods due to digital processes. What safeguards exist in digital lending? BRE rules, scorecards, caps on exposure, and continuous monitoring. What are eligible green projects? Renewable energy, pollution control, clean transportation, energy efficient projects. Why is third party verification required in green finance? The answer is to ensure authenticity and prevent greenwashing. What is allocation of green proceeds? The answer is earmarking funds exclusively for eligible green projects. What disclosures are required in green financing? The answer is use of proceeds, impact reporting, and compliance disclosures. Why is ESG integrated into credit appraisal? The answer is to assess long term sustainability and hidden risks. What is validity of sanction? The time period within which sanction limits must be availed. What is early identification of exit accounts? The answer is recognizing non viable accounts before asset quality deteriorates. What factors trigger exit decision? The answer is persistent losses, governance issues, regulatory risk, or policy violation. What is monitoring and control framework? The answer is system of reviews, audits, inspections, and MIS to safeguard advances. Why is policy knowledge critical for promotion interviews? The answer is it demonstrates risk awareness, regulatory compliance, and readiness for higher responsibility. Thank you very much for your patience. Please like and share this video and subscribe to my YouTube channel.